Okay, go. We are live. Hello, everybody. Welcome. Glad to have you here. So today, what we're going to do is we're going to have kind of an open. We're going to have an open discussion, and we're going to talk about a lot of things today. But I want to stay focused, and so we're going to talk about. Of course, we're going to talk about options, but we're also going to talk about the markets a little bit. And sorry about that pop-up. Let me get rid of that pop-up. Okay. First thing I want to talk about is let's talk a little bit about the Analyze tab here, because a lot of people have a lot of problems when they take a look at a screen like this and they look at something like an option chain, and then all of a sudden they freeze because we're not quite sure what we're looking at. And 1 second, let me let them in here. We still have people coming in, so okay. This is a stock BABA. This is a stock BABA that Dave likes to play, and I like to trade it too. This is the Chinese version of eBay or Facebook or something. But this stock is definitely going. This stock is going to go into the 200s. I mean, there's no doubt about it. There's absolutely nothing to stop it. So when I look at something like this, let me just show you what you're looking at. You guys really need to understand how to look at an option chain, because there's so much information. There's so much information on here that you really need to organize your thoughts. So when I look at something, the first thing you have to understand is what is the most important thing when you are looking at options is obviously the option premium and the option pricing. But there's something called the Greeks. Are you all familiar with at least the term the Greeks and the fact that they are the number one thing that determines what the option premium is? Okay, I'm still letting people in here. So let's take a look at this right here. And we could change the layout here. This is Thinkorswim, by the way. But here we're looking at a weekly. We're looking at a weekly option, and those of you, I'm assuming you're familiar with the terms in the money, at the money, or out of the money. And so what I want to do here is I just want to talk about what we are looking at right here. So let's start up here. So if we're starting up here we're seeing all of the different strike prices. So the strike price is your target. That's basically your ground zero. And if you are looking at calls, which is on this side, if price is above the strike price, you are in the money. And in the money means that your option premium is going to be considered it's going to have two values on it. It's going to have time value, and besides the time value, it's always going to have intrinsic and real value. So for example, if we look right now, we're sitting at 197.36. So the 197 is pretty much at the money, but if you notice, the premium on this call is 640 by 665. And the bid is 645, the ask is 660. Now, how much of that is time value and how much of that is real value? Well, if the stock price is 197, now it just jumped to 197.59, but the strike price is 197.50. So let's agree to say that this entire $6.50 is entirely time value. So this option has no real value. So if you were to buy this option, you would probably pay the ask, which is around $6.65 per contract, or $665. You are basically putting this entire premium amount at risk. Because if nothing happens and it stays the way it is, that entire $655 will be lost. And when you look at this number up there, you basically are seeing it's going to all happen over 8 days. So we are going to decay our time value of the premium, which in this case we agreed would be the entire amount, will decay over the next 8 days. So one of the things you could say to yourself is that gives me 100% risk, and it really does have to move in my favor, because the time value is going to start decaying, and every day this option is going to deplete on me. So when you look at something like that, what is going to give me the feeling that I am going to have this thing increase by more than $665 over the next 8 days? And who determined what that number is, and who set that premium, and why is it what it is? And it really has to do with something called volatility. And I believe that volatility is undoubtedly and indisputably the most important factor when it comes to option pricing, option premium, and the propensity of a stock to move. So what exactly is implied volatility? Implied volatility is basically risk. It's risk premium, where the market is pricing in a certain move by a certain time, and it's making you pay for it. So if the market thinks that this stock is going to move in 8 days, a certain amount of time, and it does it by the volatility that it sets, that's basically how it's going to price. So every stock has its own propensity to move. It all has its own personality. And some stocks are much more volatile than others, and you know that. So stocks that pay dividends tend to not be as volatile, because you have a dividend that cushions the stock to the downside. Now, fear and greed come into play over here. When markets drop, everybody gets nervous and they put their finger on the button. And the market makers know this, so they build in option premiums much more higher on stocks that drop than stocks that go up, because they want you to pay up for that, and they feel that you're at a real disadvantage when option premiums rise if you are a buyer of an option, because remember, you are paying for this. That's why they talk about option sellers taking the other side of the trade and the whole bit. Now, I'm a big option seller, but that's a whole nother spectrum and a whole nother set of risk that we could talk about at another time. But I want you to understand why we set what we set and why markets move the way they move. Now, what I'd like you to do is I'd like you to take a look at this number up here. The market has already set its implied volatility. What the market has done is this market has assigned an implied volatility of 53%, which translates to an expected move of 13 points. And notice it says up or down. So that's the funny thing about volatility is the market is basically saying is we think or we know that these markets are going to move, and we believe that based on the option pricing that we believe that these markets have the potential to move 13 points up or down. Now here's the thing you need to write down: 68% of the time, because this is considered one standard deviation. And if you look at something called the Black-Scholes formula, which is the formula that all option pricing is based off of, it's broken down into standard deviations. 1 deviation, 2 deviations, and 3 deviations. Anything beyond that is considered what's called a black swan event. But, so let's think about this for a minute. Thinkorswim gives us this number, but what if we don't have Thinkorswim? What do we do? Does that mean we're screwed and we don't have this because I have a platform that doesn't have that? Well, I'll show you how you can figure out what the move is going to be. What you do is you look at the price, 197.72. And then you look at the at-the-money strike. The at-the-money strike, if you add them both, 660 and 670 is how much? 1330. Looks pretty close, doesn't it? Let's look at the other one. This one is 1312. This is about 1280. But you notice it's very close. So you don't need to split hairs with 10 cents on either side. This here is actually the way that everybody used to do it. Is basically looked, by the way, this is called, when you buy a call and a put, it's called buying a straddle. So if you add up the straddle amount, if you add them both up, you're going to come very, very close to this amount right here. So if you have something like Thinkorswim, it's very easy to just look up here and decide how much the market is pricing in its implied move. But if you don't, just look at the at-the-money straddle. Just add up the prices of the at-the-money straddle and you come up with the same number. So that's the way of doing it, and it works on every, no matter what it is. Let's go out to the monthly in February. It's the same thing. Notice it's pricing here a 42% volatility and 16 plus or minus points. And right here, so you could just add up your straddle. You've got 840, you've got 780, and you're at 1620. So you're very close. So hopefully that's an easy way of looking at that. Now, what do I do with that number? What does that mean? So basically what that tells me is well, if the market thinks, or the market is pricing in, and the market's a lot smarter than you and I, and based on this is a culmination of all these option transactions. If the market thinks it's going to move up to 16 points, well, I could use that information. And option sellers use that information all the time because they sell premium based on where these standard deviation numbers are. And the way and they use delta to do that, and we're going to talk about delta a little we'll talk about some of the Greeks in detail a little later on. But what about an option buyer? Well, if I'm an option buyer and I see an implied move of $16 plus or minus in 22 days by February 18th, I could simply buy the 197.50 call for $8.30 with the idea that, you know what, 68% of the time this market is going to stay within $16 of a move. So I'm basically incurring a lot of risk. I mean, do you agree that that's a fair amount of risk to take on? Because this is saying that the market is going to stay within 16 points 68% of the time. So knowing that, you build your trades around the implied move or what the market thinks that the options are going to price, are going to move. Okay, so when we set strikes, let's talk about the next component that can help us out over here. So the other thing is that we start looking at something called the Greeks here, and there are 4 of them. We have delta, we have gamma, we have theta, and we have Vega. Okay, and what does that mean? The most important ones that I want new traders up to moderate traders to really master and understand is the relationship of delta and theta. Okay, so real quick, delta actually tells you 2 things. And this is real important, and this is probably one of the key things, and I'd like you to, one of the questions that everybody says is, well, what strikes should I use? What options should I use? What's my odds of making all of this work? Well, these are the Greeks that the Black-Scholes model, based on all the option pricing that's coming in, is pricing in. So basically, if you look at the delta column for the at the money, and right now we see 197.55, so 197.50 is still at the money, we see the number 52. So what is 52 telling us? 52 is actually, that number 52 is telling us two things. It's telling us two things. And it's giving us two pieces of extremely valuable information. The first thing you notice, the first thing it tells you is how much the option premium is going to move based on a $1 move in the underlying. All right, let me say that again. It tells you the percentage the premium is going to move, or the actual dollar amount the premium is going to move if the underlying stock goes up by $1. So this says 52. This says 197.50. Okay? If the stock price goes up $1, our option premium is going to move up 52 cents. So the 820 will become 872. Does everybody understand that? I'm assuming that's pretty clear. Okay? So we will get a 52-cent move on an at-the-money call. Okay? Very important to know that. So let's move out of the money a little bit. Let's move out of the money. Let's go to 205. I don't want to spend $8. See, here's where option traders, here's where they really mess up. What they think is, I really don't want to spend $8.30. Let me go a little bit down here. You know what? This $2.56 really sounds like a much better number for me. I don't want to pay $8.30. I'd like to pay $2.50. So I'm going to put in a bid for $2.50, and then let's see what happens if I get hit. So they get hit. They have a strike price of $2.15. The stock is sitting at 197, and you basically got 22 days for this thing to move from 197 not only to 215, you have to move to 215 plus the premium you paid, which is $2.56. Okay, so 215 plus 255, this thing has to move to 217.50 before you even make a dime. Now, let's think about that. 297, 215, 217, and we're at 197. That's 20 points. What is the market implying our move is going to be? 16. So now are you understanding that the odds of this all happening really, well, of course anything could happen, but options is all about math. Options is really all about math and statistics and probability. And if you understand these concepts, this applies to any stock, any market, any strike price, anything. So going out of the money and going here to 260, here's what happens. The first thing I want you to go to is look at the delta, 23. Well, that means if the underlying moves up $1, my option is going to move up 23 cents. So basically, it's going to move up a little bit on a dollar move. But as you're going to find out a little later on, it's really not, because this does not stand on its own. It interacts with all of these other Greeks. But it gives you an idea of that the market is pricing that, you know what, this thing's going to move up a whole $1, and I'm really only going to get 23 cents of it. Tells you something that's also twice as important as that. This also gives you the odds of this option finishing in the money. So let me say that again. If we are at the money, and this will make it crystal clear, if we are at the money, the stock could go up, the stock could go down. It's really a 50-50 shot, isn't it? So if I have a stock that's $200 and I do the 200 strike price, It could go up, it could go down. It has a 50-50 chance of going up. It has a 50-50 chance of going down. So it only makes sense that my delta is going to be 50. And I'm going to make 50 cents on every dollar move. Okay? Very important to understand those two things. And if you get that, you start to get the sense of how powerful delta really is that delta tells you so much stuff. So right here, I'm telling you, we have a 53% chance at this moment of this option and this strike price finishing in the money. Okay? Again, very close to 50-50. The market could go up, the market could go down. Once I go down and I buy out of the money and I pay $265, now I only have a 23% chance of the option going in the money. So now there's one chance that it's going to go in the money, and it's probably, it looks like a 4-to-1 shot against me, right? 4-to-1 shot, possibly even close to a 5-to-1 shot that I'm going to lose money on this trade. Okay? So you understand that the strike price that you pick, the market is giving you clues of what it thinks its implied move is going to be. Is it always right? It can't be always right because markets actually at points are random because they're based on binary events, right? Anything could happen. In this market right here, a lot of things get shrugged off. But, I'll tell you, people are watching the bond market, they're watching the dollar, and people are getting really nervous with their finger on the button right now because this market has done nothing but go up since the election. And, we're up 30% since the election. That's quite a lot. But be that as it may, we still have a friendly market behind us. We got a friendly Fed. And we still got some market structure, and we've got a lot of buying going on out there. So the market bias is still to the upside. So you don't want to fight that tape. So in this market, the number one thing you want to look at is which way is the market trending. The market's trending up. Why would you look at puts? Why would you look at something that goes contra to the money and take a chance on something like that? What I would do is I would look for pullbacks, but I wouldn't necessarily look for puts. I wouldn't be necessarily buying puts unless I'm protecting a portfolio, and that's another conversation when we could talk about VIX products. And as Dave and I go on, we're going to talk about a lot of things. I mean, you guys are going to understand this thing cold, but you're going to look at it as a trader looks at it. And with the way I'm looking at this right now is, I know Dave does a lot of spreads, and some of you are into spreads and some of you aren't, but when you deal with these higher priced stocks, personally, for my taste, with the stock right here is 198.26, leaning towards 200, laying out $755, knowing that the stock has to make a fairly significant move in a relatively quick amount of time. Otherwise, time decay is going to start eating this thing up. So one more very quick. I'm going to close out on Delta right now, and we'll combine it as we do this one more time. I'm just going to summarize it. Let's bring up another stock because you're going to see a different set of numbers. So let's bring up something like Microsoft. Okay, so let's go to a weekly. Okay, so here we have 8 days to go. Now, everything's the same, nothing changes. Once you learn how to do this once, you can do this with every stock. You can do this with every stock, every option chain. I want to make you a pro at reading these things. So what's the first thing we're going to look at? The first thing we're going to look at, the implied volatility is 41. Because it's doing the calculations for us, that 41 is not all that significant, but if any of you guys are really into the math, one of these days I could send you an email and show you what that 41 really translates to, applying it into the Black-Scholes model. But we got computers that do that now. We don't need to do that anymore. So this is basically saying over the next 8 days, Microsoft can move within $4.69 68% of the time. This is not saying that Microsoft is going to move $4.69, Markets don't predict that way. What it's saying is that the markets will move within a range of $4.69 up or down 68% of the time over the next 8 days. That's the information you got to take away, is that if the implied move is $4.69 and the price is 92, and I want to buy an out of the money call for 63 cents, which happens to be $6 away from price, what's my chances of making money on that trade? You now know enough to be able to tell me the answer to that, because it's not a secret. Just go along and look at Delta and you'll say it's 19%. Okay? Hopefully everybody sees that. I don't have the join me, so if you're writing questions and everything, I don't see them. But if you want to type them in the chat box on Dave's website, I will see them. Okay? Just making sure that you now have the information to see why going out of the money, unless you're really speculating, tends to not be the best choice. And if you want to be a trader, speculating should be no more than 3 to 5% going with this out of the market stuff, out of the money stuff. So I know that if I'm buying a call, 68% of the time we're going to stay within $4.68. I'm going to be looking at calls right in this range, somewhere around the money. Okay? That should make sense to you guys. All right? So at the money, again, where did I get this $4.68 from? And what happens if I don't have that number available to me on my platform? Let's add up the at the money straddle. It's 92.24, so it's right in between these two, but you'll get the idea. 247 and 217 is 450, 464. Boy, that's pretty close, isn't it? That's within 4 cents. So if you don't have this money, if you don't have this number, just basically add the at the money straddle, which is the call and the put. Add the two together. That's your measured move. And that's your put call parity, guys. There is a relationship between puts and calls. And put call parity makes all this stuff really work. Now there's things like skew and all that other stuff, and we'll talk about that, because markets, it's not always going to be in balance. You will see the market price in downside more than upside and vice versa. And again, all of that is priced based off the calls and puts. All right, there's a question on how do you calculate spreads then. Bear with me, okay? Bear with me. I'll talk a little bit about spreads too. I want you guys to know this option chain cold, because we'll have a test on it next time I come on, because you're going to be throwing these numbers at me. Okay, so at the money should be around 50-50, shouldn't it? Okay, we're right at 50. Look at it, 53 and 92.50, which is 25 cents away, is right at 50. Now that makes sense, right? 50% potential of going up, 50% potential of it going down. So at the money is always going to be 50. You're going to get 50-cent move on a dollar. So if you buy 2 calls and you buy 2 at the money calls, your theoretical move will be $1 for dollar, because your deltas, a share of stock, I didn't tell you this before, but a share of stock is 100 deltas. Okay? 500 shares of stock, 500 deltas. Okay? Every share of stock is 1 full delta. These are increments. So this is 0.5, but every share of stock is 1 delta, 1.0. So here's the 50% move. Let's go out of the money a little bit. Let's go down to a 97. We want to buy a 97 call. So if I buy a 97 call, how much is it going to move? It's going to move 23 cents on a dollar, and my odds of it finishing in the money are 23%. So I hope you're getting a feel now that you're call buying or option buying puts the risk on your side because you need the stock to move by a certain amount to get yourself a certain profit by a certain time. Otherwise, it expires worthless. Anything that expires out of the money goes to zero and it ceases to exist on expiration date. There is no intrinsic value if you are not in the money. Okay? Give me 1 second, guys. Sorry, I'm back. Okay? All right, I think we beat delta to death, and hopefully you took some notes on that. But those are the two things that delta tells you. All right, let's talk about the next most important Greek there is, and that's theta. Theta is time decay. So option premiums erode. It's a wasting asset. It's an implied contract, and it ceases to exist at expiration. So it only makes sense that if you are paying time premium and you have 8 days to go and your stock has not moved, as time goes on, it's going to be less and less probable that you're going to make money, all things being equal, if the stock doesn't move. So what happens is this Greek called theta actually tells you how much the stock is going to decay in a certain day. So this at the money, let's use this one, 92.36, we're at the 92.50. We are the at the money call is going to decay 13 cents. So you have 229. If all things being equal and nothing happens, this thing will be 13 cents less tomorrow. And then this theta is going to change because now you only have 7 days left. So it's going to start to pick up steam and accelerate. So when you think about how markets work, one man's loss is another person's gain. So the option seller who took the other side of this trade where you were the buyer is going to profit this 13 cents. Okay, so understand that whatever you lose is what somebody else makes. Whatever you make is money the seller lost. It's two-way markets, zero-sum game. Somebody wins, somebody loses. That's how the markets work. But the option buyer takes a little bit more risk because they have to be right in a certain amount of time. So we talked about delta, we talked about theta. So here's a little scenario, and you could actually, you could play with something like this. Is let's say I want to buy one call right here. So I want to buy this one. So I want to buy this. And so you could see everything pops up right here. And look at what it tells me. It tells me the delta is 47.43, which means, you know what that means, right? We'll talk about gamma another time. My theta says that it's going to decay $11.09 overnight. And Vega is volatility. We'll talk about that another time also. And this is really meaningless because this is reset from something else. But here is the information that it gives you. And then Thinkorswim also gives you some scenarios that what does it look like if the market moves up 10% or up down percent. And you could see that if this market moved up 10%, we would be making $688. Okay? That's a nice chart that I just saw posted right there, because that shows you the rate of time decay, and it really starts to accelerate in the last 30 days of the trading, and especially in the last half hour. So basically, this is kind of like this kind of stuff that you look at right here is I'm going to pay this for it, and this is my what ifs, and then you could start playing with different things on the Thinkorswim platform. But I want you to get the concepts. I want you to understand that you could look up and you could do this with any stock. What's another one you looked at? Okay, I know Dave was talking a little bit about AIG. Okay, let's look at AIG. Okay, we look at AIG, and again, it's 64.69. We look at the at the money, and you could see this is very interesting because you could see in 8 days the implied, what's the implied move? Look at the volatility, 1756. And the implied move is only $1.40 plus or minus. And now you're really understanding now what volatility has to do with it. Remember those other volatilities were in the 30s and the 40s? That's because the markets are pricing a much bigger move on those stocks than AIG. AIG is a much more stable stock, okay? And stable stocks, you'll notice, have lower premiums, but they also move less, okay? They're not exciting, but they're steady, and you're not quite sure what they're going to do, but these are nice stocks to learn on because you don't get the wild swings. And when you do that, it becomes sort of a lot, it takes a lot of the stress out. So if I'm looking at a stock like AIG and I buy a call on AIG, okay, I think it's going to make a move. The market's only pricing a $1.40 move. So if I buy a couple of contracts here, you know, if it gives me a little bit of a move, I get 55 cents on a dollar, I could do okay with this stock in a relatively small period of time. Worst thing that's going to happen is so it's going to decay a little bit, but I still have a couple of days to try it. So these stocks that aren't the big outliers, the stocks that move that much, those are the ones that are easier to learn on. They're a lot less disruptive, and they're just good stocks to trade. I like trading. One of my favorites to trade is Bank of America. And one of the reasons is because it's so darn liquid. It's so darn liquid. Everybody's trading it. And look at how tight your spreads are. Your spreads are 2 cents wide. So I really like trading Bank of America. So with Bank of America, we have $32 stock. Here's 32. And look at this one. In 8 days, we have an 18% implied volatility. The implied move is only 73 cents. The implied move is 73 cents. I love trading this stock because you could just play in this sandbox all day long, and Bank of America will give you a nice return. Stock moves 30, 40, 50 cents. You make a really nice return in a day, and you could be in and out of this thing. So would I rather do that, or would I rather do something like Amazon? Okay, now you're getting in the big boy sandbox. So we go to, let's look at what a weekly looks like on Amazon. Okay, Amazon is trading at $13.72. So here's your at the money. Here's your at the money. Okay, good luck with this one. This one has an implied volatility of $54 and an implied move of $93 up or down, which is basically saying the market will range within 180 points over the next 8 days. That's an incredibly volatile stock. But option sellers will position their short strikes 90 points out of the money on either side, hoping that it stays within that range. But can you imagine if anything goes outside? I mean, you've seen what happened with Priceline. It may move $200-300 in a day. So these are really stocks that if I were to trade these stocks, I would do spreads on these because, you know, unless you want to lay out $4,800 for a contract. But again, when you do something like a spread where you're buying and selling an option, these are really great viable trades. So my rule for myself is the big boy stocks over here, I'm very happy doing spreads, and I'm very happy doing multiple contracts because you've mitigated so much of the risk. But with the low price stocks, the ones that you could get some nice movement on, I have no problem doing calls. And I know I didn't talk about puts, but puts operate exactly the same way, but just in the other direction. Okay? So this is basically you know, we looked at a bunch of different stocks, and you're looking at the deltas. So let's see something here. So we have a 92% implied move here. So let's say I want to, but even if you wanted to go 31 points out of the money, it's going to cost you $3,400 to buy one contract of Amazon. Okay? And you got a 40% chance of it being in the money. And you've got a 42-cent move on every dollar move in Amazon. So if Amazon moves $10, you've moved $4. Your option moved $4. That's not a bad return. That's a 10% return. So there's the argument for something like that, but you've also got a lot of time decay. So if I wanted to buy this, let's take a look at this one. Okay, now look at this. Your delta is 43. Look at your theta. Your theta is, you're going to lose $225 tomorrow if Amazon doesn't move. Gone. And then the following day, you're going to lose some more money and some more money. And if Amazon moves against you, it will incrementally go the other way. So these are the kind of stocks that, in my opinion, you should really just do. You should really just do spreads with these unless you have a big account and you have some really good conviction that you feel that this stock is going to move a lot. So these are the two main Greeks. So delta and theta. Just briefly, Vega is implied volatility. Vega basically says that if there is an increase of 1 point or 1% in implied volatility, my premiums will rise 84 cents. That's a lot. That is a very profound statement, because because if you are an option buyer, you love that because it will raise your premium and you will be making money if something like that happens. So could you imagine if volatility goes up for whatever reason? And what makes it go up? News makes it go up. Something that the market is going to price in a larger move than normal sets implied volatility to rise. And if implied volatility rises and the stock moves up, you have a delta moving up, it offsets your theta, and it comes up with another option premium. The point is that when volatility is low and expected to rise, you want to be a buyer of options. No doubt about it. You want to be a buyer of options. And when is volatility low? Volatility is low right now because the markets are going up. Fear and greed. Right now, there's a lot of complacency. So if there's a lot of complacency, option premiums are a little lower than they normally are. Well, what raises them? Earnings raises them, because I'm adding an element of unknown. I'm adding an element of surprise. Nobody knows how the market is going to react to the earnings. So what happens is they raise the volatility and they make you pay up on that premium. Who's announcing today? Nike's announcing, aren't they? Starbucks. I think Starbucks is announcing. Okay, Starbucks is announcing. I think they are. Okay, look at the volatility on Starbucks. It's up to 94%, and its implied move is $3.17. Starbucks is not the most, and neither is Intel. I see that. Thanks, RC. Starbucks is not the most volatile stock in the world, but this is a $3 implied move. So what happens is you will be paying up. You'll be paying $1.72 for this option. And then come tomorrow, once the event is over, the volatility will be sucked out of the option because what was previously unknown is now known. And that's what changes volatility. And that's why it's so important for you to look at news and know what's going on in the market when you are an option player. It's so important not to just blindly do things. You want to look and see if you're playing bank stocks. You want to know when the Fed is meeting because that's interest rates. You want to buy calls in front of a Fed meeting? Maybe you do, maybe you don't. But the volatility is going to be very high. So if I'm buying a call on the morning of a Fed meeting and I pay $3 for that call, the minute the Fed meeting ends, the volatility drops and that $3 premium drops down to maybe $1.50. Why? Because the unknown event has happened. I'm back to being complacent again. I'm not nervous. I'm not edgy. I know everything that I need to know. There's nothing else that's going to surprise me. Volatility shrinks. But so does my option premium. So when people buy an option in front of an event, and the event happens and the stock goes up $2 and you're thrilled until you look at your option premium and say, I just lost money. How could I lose money? Well, you lost money because volatility dropped once the event came out. So that's real important. I mean, I don't know how experienced you guys are, but how many times have you made an earnings trade, the stock went in your favor and you lost money? That's because all the premium was sucked out after the event happened. Okay, I have a question here. So it makes sense if I am playing an earnings play to buy on low vol maybe 2 weeks before. Akiva, you are right on the money. You are so on the money. I want to show you guys something. I want to show you something really cool. This is a game changer, guys. I'm going to do this, and I'm going to do this. And I want to add a study, and I want to add implied volatility. Give me 1 second. Okay, I'm adding implied volatility. Take a look at this, guys. This is really interesting. Here's your implied volatility. Now, this is a study. This is on every platform. And if you take a look at this, look at how it spiked for Starbucks going up into the news event. Just check that out. That increased your Vega, because your Vega is your implied volatility. That increased your option premium on the buy side. And as soon as they announce those earnings at 4:05, whatever it is, I will guarantee you tomorrow you are going to see what we just seen right here. And here's the proof of the pudding. I want you guys to take a look at this. Look what happened. Here's an earnings announcement. Look at the volatility crush. Here's an earnings announcement. Look at the volatility crush. But it's also telling you, look at when volatility is low. So in this case, you kind of estimate around the middle of September. But what you do is draw some trend lines over here and kind of gauge when volatility starts to break out. It seems to break out somewhere around here. Okay, so notice that in anticipation of a binary event, and in this case the binary event is earnings, implied volatility is going to rise. Should I be a seller of options in front of that? Please say no, because when you buy calls, a rise in volatility raises the premium price. That's a very good thing if you are a buyer of calls or even a buyer of call spreads. That's a very good thing. If you are on the other side of that trade, the gain that the call buyer is experiencing as the market rises going into the earnings event is going to be a loss for the person who is short that option. Because as we get closer and closer, implied volatility going up is a very bad thing for the option seller. Remember, it's always a zero-sum game. Whatever money you make, the other person is losing. Whatever you lose, the other person made. Okay, question here, Ray Janice. Should we also look at IV for calls and puts? They sometimes seem to track differently to the overall IV, probably giving us a sense of direction of earnings. Ray, you look at the IV of calls and puts, but remember IV is derived from the options activity for calls and puts. So there's some place, I'm going to show you that. Give me 2 seconds and I'll get there, and I'll show you where we could look to see something like that. Now, so this is basically implied volatility. You guys should have this on your chart for every stock you're looking at. If you don't even think of trading options without this chart on there. And if you want to go one step further, there's another study called historical volatility, which you can overlay on here. Now, historical volatility is what happened in the past. Implied volatility is the future implied movement of the stock. We know that. That's the unknown. Historical volatility we know. So by comparing implied to historical, it gives you an idea of the regression back to the mean. Okay? So let's go back to our Analyze tab here and let's look at Facebook. Okay, I want to close this. I want to close this one. Okay, this is now, this is going to be so apparent to you after I show you this. Now, remember what I told you. Volatility rises going into a binary event. The binary event is earnings. Let's just look at this column right here. We have an implied volatility today of 21.65%, or an implied move of $2.23. Next week, we've jumped to 46% implied volatility and an expected move of $10.77. Check out the following week after that. Do you see the volatility drop from 46 to 38? What does that tell you? I could tell you right now, earnings is in this week, because here's where they price the volatility. So I don't even need to know the earnings date. All I need to look at is market structure and show you what the market is pricing in. And I'm seeing that it's doubling the volatility between today and next week, more than doubling the volatility. We're going from a $2 expected move to a $10 expected move. Why? Because Facebook is announcing earnings. Got it? This should be like aha moments, okay? And the following week, the event is over, volatility drops. So what is that telling you? This is telling you that coal premiums are extremely expensive this week. They're going to be through the roof. Look what you're going to pay for 1 week. It's for the 187.50. You're going to pay $5.50. You're going to pay a very high premium because it's pricing in that expected move based on the binary event of earnings. Okay, makes sense? And now I could go over here and take a look. January 31st is the earnings for Facebook. So not surprising, not a surprise. So go to the Analyze tab. Let's take a look at something. Here is something called option statistics. Okay. This is something Thinkorswim has. Some platforms have it, some don't. I could spend a day on this, guys. I could spend a day because there's so much in here for you to learn about what this is telling you that we'll do this in another session. So I'm throwing a lot of stuff at you. I'm hoping you're absorbing, most of it. But I really wanted you to get how to read an option chain and what the market is trying to tell you based on option premiums. Your ratio of calls to puts on Facebook is more than 2 to 1. You've got 163,000 calls versus 65,000 puts. I'll teach you this, but trade it at bid or below or trade it at ask or above. Here's the thing you don't know about these calls. You don't know whether these calls were bought or sold. Remember, there's something called a covered call, which is a hedge, right? Covered calls are a hedge. It's an income play. It's a hedge. It's a lot of different things. So it doesn't necessarily mean that everybody's bullish, because I don't view a covered call as bullish. I view it as somebody that is capping their upside. So, but if you trade at the bid or trade at the ask, remember something, there's a bid-ask spread. When you buy, you typically buy at the ask. When you sell, you typically sell at the bid. And then a lot of times you strive to go in between the market and get the midpoint. Okay? But this is telling me that people who have did these at the bid, I'm going to guess those are covered calls, because the bid is less money than the ask. And if I'm selling, I'm going to receive the lower amount of money. So I'm going to say that up to about 50,000 of these calls could potentially have been covered calls. Okay? So it tells you a lot of stuff, and then it talks about the deltas. Where did people actually sell? So there is a ton of information on here, but for you, what's important? What's important is knowing, are people on the buy side or are they on the sell side? The other thing is the option time and sales. Here's where we look at and see where we have now these are all the individual sales, but these are the big trades. These are the institutional trades. Here we have 3,415 calls and 2,500 puts. And you could go actually out here and you could find these strikes and you could look at the transaction. But let me give you a clue. Does that mean anything? Is that unusual option activity and all that? And I'm going to tell you it's not. And I know it's not because it is part of a spread. So I hope you're seeing the value of something like Thinkorswim for option traders, because when you learn what this stuff is telling you, the stuff that this platform tells you is tremendous, and it gives you so much information and allows you to really zero in and come up with some educated guesses on what to do to try to put little edges on your side. So this is a little bit about time and sales. We could talk about this more another time, but let's look at another stock. Let's look at Starbucks. I always do this on earnings because I want to see where the money is. Okay, so if I want to trade an earnings trade, isn't it interesting that there are more puts than calls on Starbucks? This is telling me that the market is hedging lower. So this could be a couple of things. So this is telling me that some people could have bought puts to protect long positions. It also could tell me that people are betting for it to drop. But it's not really that much. I mean, we're a little over 70 on the call side, 105 on the puts. It's not like it's 2-to-1. But the sizzle index is telling me the option volume is 3 times the normal. And sizzle index is another thing that Thinkorswim has that tells you if option volume is above its normal volume and what that ratio happens to be. Okay, so in this case, Starbucks is only trading about 3 times normal, which is certainly not a lot. And it breaks it down into calls and puts. And here's the raw data right here. So what would I do here? Would I be buying calls on Starbucks? It depends on what your output is. It depends on what your outlook is on the stock. You look at the history and see what did Starbucks do historically. I can tell you 59% of the time Starbucks goes up, and that's based on data that goes back lots and lots of quarters. But this is stuff that I want to know that gives me ideas if I want to get involved in this stock down. Let's look at Intel. Intel, I believe, is also... Okay, look at Intel. Calls and puts, pretty close, and sizzle index is 2.5. Now here's it's interesting. Here's your implied volatility because it's announcing today. Implied move is $1.82. Look at it next week. Do you see how it drops? It drops to 41%. So you know right now that there's a binary event happening either today or tomorrow. And that should be so telling. And you do that with any stock. So let's look at the options here. So here's your options. You want to buy the 45 call right now? You're going to pay about anywhere between $1.04 and $1.09. And you see the implied move is $1.83. just add the 2 and you see $1.07 and 77 is $1.84. This stuff works, guys. This works on any stock, any option, any time frame. This is how it's done. And we know the delta. This is telling us how much of a bounce we're going to get for every dollar it goes up. And it also tells us what the odds are of finishing in the money. We know that at the money is going to be about a 50-50 proposition. And as we go out of the money, we have less and less of a chance. So basically, and here's a real example. You could see here you have options that are priced at a penny, that are priced at 10 cents. This is, if you want to buy this option, you have a 10% chance. You're looking for an outlier of this thing to move $3. It's only supposed to move $1.84. 68% of the time, you're really looking for something very unusual to happen. Can it happen? It can absolutely happen. But more times than not, it's a speculative play. You have a feeling, you want to do you want to play the lottery, get your lottery ticket out, buy 50 contracts at 10 cents and see what happens. And that's all I can say about something like that. Is it trading? It's trading. It's all trading, but this is more speculative of nature. I'm trying to instill a science in you. I'm trying to get you to think in terms of a trader, trying to look at at odds. And believe me, we haven't even looked at a chart yet. And charts is, we're not going to get through charts in one day because there's so much to charts, and it's such a science, an art and a science to learn charts. But if I could get you thinking and understanding what an option chain looks like, and to take the part out of it that would make you feel uncomfortable, and every one of them stands on their own. And this is how far out. You can buy these things all the way out 358 days. You can buy a leap. And people do buy leaps, and there's so many different things that you could do with options, but it's all the same. You read it all the same. If I wanted to buy an option that's a year away, the implied volatility is 27%. Big deal. I do know that the market is pricing a $10 move up or down. That's valuable to me. I'm going to pay $4.60 for it. Well, if I'm paying $4.60 for it, and 68% of the time the market thinks it's only going to move $10, I'm already into it for $4.60. The most I could make is $5.40. That's not a great risk to return ratio, is it, guys? I mean, not for me. That's not a great return to risk. I got to see a lot more return for the risk that I'm going to put on that. And that's how I want you to think. I want you to think that this is a cost basis here. This sets your break even from 45 to almost 50. And because it's going to be almost 50, you're not going to make a dime until this thing exceeds 50. And if the longer it takes, the more theta is going to erode at it, and the more it's just going to be less and less likely that you're going to make money on it. Now, I can teach you some diagonal stuff and some synthetics that you could buy calls and then you could sell. You could sell shorter term calls against it, and you could collect premium because this actually acts as, oh, bell's up. Okay, this actually acts as stock. So that's all more, more things to come. But are there any questions? Are there any questions you have basically about what we covered? So type it in the chat box because I don't have the join me up right now. Okay, remind me of Vega again. I got to thank you. But here's Vega. Okay, Vega is implied volatility going up. Now here's the deal. Here's the deal. Let's go back to this chart. And you're going to see this. Now look at Intel. Look at Intel. Notice what you do with this chart, and this is a really cool thing, is you pick a stock that's going to be announcing earnings, and I don't know. All right, let's say J.P. Morgan. They already announced, but the thing is that you're going to notice that you have these volatility drops right after the earnings. But it's real important that you start to recognize typically when volatility starts to go up. that's going to be free money in your pocket, because Vega is the amount of money that the option premium is going to go up for every $1 move. Okay? And yes, it's the 68% means it's staying within the range, but up or down. So if the implied move is 10, that means you have a 20-point range. It's 10 points up and 10 points down from current price. Okay? That's your 60% move. Okay, just seen something, Starbucks taking off. Let's go live. Let's look at the 1 minute. I don't know if I have aftermarket. I gotta turn on. Give me 1 minute. Let me turn on extended. Let's see what's going on. Equities. Show extended hours trading. Apply. Good. Okay, take a look. Look at what happened after market. We had a spike up. They announced the earnings. We had price rejection here. It comes down, and it's actually selling on the news. Now it's gonna bounce around a lot, but here's your volatility, guys. This is why volatility goes up into earnings, because you cannot predict this. We don't know. This thing is going to jump around, and it's going to jump around for the next hour or so. The bottom line is you have some traders now that trade after market, and they trade the stuff after market, but it's dangerous because it's limit orders only, and you really need to know what you're doing. But here you see why we have volatility going into expiration. Okay, you have volatility going into a binary event like earnings, and then it tells you what it's going to be, and then tomorrow you will see that volatility will just be sucked right out of the option. Okay, here's what we got. Let's close this. And here we go, right here. 82% today. Next week, it's going to be 42%. That's 40 points of volatility coming out of the option. You do not want to be long post, because that's when all the volatility comes out. This is what the option seller hopes for, because the option seller makes money when volatility drops. The option buyer loses because this gets taken out of the option premium. Okay. Okay, question is the other side of the 68%, 32% that it goes outside the range. Okay, one standard deviation is 68%, and then you have two standard deviations is 95%. So we go from 68 to 95. And that means that 95% of the time, price will be within the range of two standard deviations. And what is two standard deviations? Just take one deviation and double it. So basically, if this thing moves, if you think it's going to move two standard deviations is 5.4. Three standard deviations is about 8. And that's how that works. But yeah, and knowing those numbers, you're looking to see, options is all about math. You don't understand what a deviation is. A deviation is a mathematical term. It's basically, it's not limited to options. A standard deviation is a distribution curve of price, and a standard distribution curve is always going to look like a bell curve. And in the middle of that bell curve is one standard deviation. And then as the bell curve starts to flatten out and it starts to extend itself, that's when you have the two standard deviations and three standard deviations. But it's a distribution curve. And when you do is basically when you take statistics, yeah, kind of. 2 times Bollinger Bands means two standard deviations. Well, is it really two standard deviations? It might be. It depends on how they're set. But I think Keltner channels is standard deviations. Okay? So confusing. Sorry. Okay. Okay. You might be getting hung up in the math. Okay, hold on a second. Let me read this. We are always better. Okay, there it is. It was just posted. Thank you for that. What you're looking at, this should help you out. This basically says that look at the dark blue. 34.1, 34.1. 68.2% of the time, that is one standard deviation. That means price is going to stay within there 68% of the time. Next, we're going to go to 95%. That means another 13% on either side takes you to 95%. All it is a mathematical statistic. And once you start going between after 3 sigma and all that, you're into something that's black swan events. That's when somebody looks at it and says, holy smokes, did you see CMG just dropped 150 points because people got, you know, the Ebola from their food? That's not even a 1 or 2. That's probably a 3, 4, or 5 deviation move. That's called a black swan event. Those things happen very, very rarely. And we typically can't predict them. We certainly can't predict them because that's like predicting where lightning is going to strike. You just don't know. So, and it's true. Standard deviations apply. They're all about mathematics. This is how standard deviations are applied in the options market. And it helps you as a trader if you know that an event is going to be true 2/3 of the time, right? If I know an event is going to be true 2/3 of the time, then over time, the law of large numbers says that if I stay within a standard deviation, I will be right 2 times for every 1 time I am wrong. Okay? Which gives me an edge. But does that give the option buyer an edge, or does that give the option seller an edge? And therein lies the paradox, because I'm going to tell you that that's what gives the option seller their edge, because the odds are on the side of the seller. Okay, the odds are on the side. The odds are on the side of the seller. The problem is because when the problem occurs, when option sellers are wrong, their errors are magnified. So, and it's kind of hard to understand, and we'll look at this more in another lesson. But if I am right 2 times out of 3, and as a seller I'm right and as a buyer I'm right 1 time out of 3, I could tend to make more money the 1 time I'm right than the 2 times that I'm wrong with proper management. And therein is why people say that it's better to be the seller than to be the buyer. I'm going to say that it's about the same, because if there was a true edge, the edge doesn't exist for you and me. The edge exists for the people that capture the spread, that don't have to pay the VIG. But we have so much overhead that we have to pay for, it negates that. So I'm going to say that if I sold a 10 delta option, which basically says there's a 10% chance that I am going to go outside of the money, that means 9 times out of 10 I'll be right, 1 time out of 10 I'll be wrong, but I'll guarantee you the 1 time out of 10 that I'm wrong is going to negate almost all 9 of those times that I'm right. And that's just basic. That's just basic option theory and just how it goes. Now, everybody has different experiences, but everybody who is a seller of option will tell you that the 1 time you are wrong is the time that really knocks you on your butt. And that's the danger of selling options. But I have a way of selling options that's pretty cool, which I'll teach you. And it takes away a lot of that risk and really gives you some edges. But you know, but Theta is simple short option. You can win in 2 ways. That's correct. That's correct, RC. So Okay, teach them how to manage risk. Okay, I know Dave wants me to teach them manage risk. We are an hour and 14 minutes into this stuff. and we're certainly not going to, I'm just going to give you, I'm going to look at Starbucks right now. Look at what Starbucks is doing. This is after hours action, guys. Okay, I'm going to give you, we're going to talk about risk in an entire session, but I'm going to give you how I manage risk. And I'm going to give you my theory on how risk is managed, and I'll tell you how the pros manage risk. And risk management, when these professional traders, they have they have accounts in the millions of dollars that's at their discretion to trade. However, they have very, very strong risk parameters, and they are watched very closely, and nobody really cares what they trade or how much they trade as long as they stay within the risk parameters. And I'm going to tell you that never risk, how do I want to say this? If I am putting, let's say I'm buying an option for $3, I have to have a risk to reward ratio of at least 3 to 1. I've got to make $3 for every dollar that I'm willing to lose, which means that you've got to manage your positions. You can't set and forget it, or I have to put on an alternate trade that hedges off of it. But I look for 3 to 1. A lot of people say 50-50. I don't like 50-50 because 50-50 never works out that way, because you got commissions and you've got all this other drag and all this other stuff that they trap you and you can't get out because the bid-ask spreads. The worst time to get out is when you want to get out. You get out when you can get out. You don't get out when you want to get out. But what I basically do is I look at my deltas. Deltas tells you everything you need to know, guys. Let's go on the Analyze tab. All right, we're looking at, let's go to something with a little more juice in it. So I'm looking at Facebook. Okay. All right, here's my Facebook. And my delta is 58. And I've got 22 days. And I've got some theta working against me. Now, as delta, remember what I said about delta being the probability of being in the money at expiration. However, between now and expiration, anything could happen. So between now and expiration, I could get nice gains. You know what I mean? But expiration is when it all comes to pass. So we don't really like to hold until expiration. Okay? You're welcome. But here's my thing. If I've got a 58 delta and I've got $8 into this thing, once my odds start dropping, I'm not too thrilled about this trade anymore, because just think about it. If you lose 50% of your premium, how much of a premium gain do you need just to get even? Answer is 100%, right? So if I put $8 into this and my premium drops to $4, for me to get back to $8, the premium's got to double, which means that the stock has to make a hell of a move. A hell of a move. Probably one that it's not going to make. I mean, it could, but we're traders here. We don't play the should, would, could, maybe, praying. That's not how it's done. I mean, there's always a little bit of risk that we're willing to take because we're risk takers. Otherwise, we're not trading options, right? But for me, if this thing starts moving against me tomorrow, I start thinking about this. I start seriously thinking about this trade. I'm not going long an option to watch it drop tomorrow. Now, at the same time, you also got to give it a little bit of time also. So I want to know why. If the entire market is dropping, okay, that's a different thing, because everything drops when the market drops. About 70–80% of the stocks follow the broader market. But if fundamentally something happens, and my impression or my estimate or my assumption is wrong, I have no problem with taking half off or taking a third off because I want to pull some of that risk off. I don't have to take the whole thing off. But if you realize that if this thing doesn't move for me right away, there's a very good chance that now I've got more of a chance of losing money on this trade than making money on this trade. So if I had 10 contracts on, there's a very good chance I might take 2 or 3 off just to take a little bit of risk off the table. And look, that's my philosophical opinion, because I think preservation of capital is very important. Now, of course, it could reverse to tomorrow. That's why I kept the rest on. But I want to see an option or a position move in my favor immediately. Otherwise, my timing was wrong. Perhaps my assumption was wrong. Perhaps there's something going on that I didn't take into account, and I start to rethink my position. So I'm a little bit more conservative. I got more conservative as I got older, and that's maybe just me, but depending on your risk tolerance, and if you set certain goals for yourself and say that I'm not going to risk more than 2% of my capital on any trade, then you govern yourself accordingly. And we could talk about position sizing and stuff like that. But if you got a 10%, if you've got a $10,000 account, you certainly don't want to risk $1,000 on a trade, because you're risking 10% of your lifeline or your working capital on one trade. Why would you do that? But I would maybe put on a position for about $500 or $600 with my stop loss at 2. Once $200 is gone, 2% of my working capital, I'm out of the trade. So there's another way of looking at it. But I go by 2 things. I go by how much I'm willing to lose on a trade, which is typically a percentage of the position. And I basically go on a gut feeling about my assumption of whether I was right or wrong from the whole trade to begin with. I also look at the sector. If I'm doing a bank trade and I go long Bank of America, and something happens and there's some banking news or something with Europe or Draghi's raising rates and all that other stuff, hey, you know what? My assumption was wrong. I did not expect that. Bank stocks are going to get hit. Take a look at the XLF. The XLF sells off. You're wrong. Get out. So that's kind of my philosophy on it. And, you know, that's my philosophy on money management and trade management. But I also do it with charts. And we're not going to be able to get into charts today. I didn't think we would, but I really wanted this to help you and make you understand how to read an option chain and understand that it's not scary, because every strike is exactly the same. They all work the same. They all have an expected move. They all have a volatility. If you don't have the expected move, you add up the straddle. The delta tells you how much it's going to go up or down for every dollar move. The theta tells you how much an option is going to decay in a day. And if you understand that, then this was a very productive lesson for you, because this is the fundamental and basics that you really can't go further. You really can't go further unless you get this. Okay, last time on Vega. Okay, Vega is the amount an option premium will raise for a 1% increase in volatility. And again, what's volatility? Volatility is, it's basically the risk that talks about the risk premium that's going into a trade. My computer just got really slow, but oh my gosh, look at this. Well, let's hope it comes back. Oh, desktop, no, wait for the program to respond. But this will be on YouTube. Yes, I'm actually going to, because this happened, I'm going to stop. Oops. Okay, this might be a second recording. But anyway, so here it is. Here is your implied volatility. You see how your implied volatility is going up? When implied volatility is going up, Vega is going up. And for every percent that Vega is going up, you look at the Analyze tab, you look at Vega, and that tells you how much your option premium is rising. Okay? So hope that clears that. So if you have any question, I'll tell you what. If you have any questions, post them in the chat room. I'll hang around and I'll go in the chat room a little later and I'll answer some of them. And other than that, I want to thank you for being on the call. This was pretty cool. I'll work with Dave and I'll get this uploaded. And we'll see you next time. I'll stick around a couple of minutes now if you have any other questions. You're welcome. Hope it helped. Yeah, thanks, Robert.